Welcome! Today I will use the Holt lens to analyze the Coca-Cola company. Let's look at their CFROI levels first. There are several important observations. Their CFROI is consistently above the cost of capital. The peak is above 35% in 1997, followed by smaller cycles with local peaks. For example, in 2001, the growing trend in CFROI draws to an end in 2008, starting a steady declining trend of declining company returns on gross investment. The market's expectations for its internal rate of return are higher than those calculated in Holt lens. Despite decreasing CFROI, Coca-Cola has done well in earning returns above the company's determined hurdle rate. These high returns draw competition, leading the company through the stages of fade. The rate of fade is slower for Coca-Cola because its CFROI is not as volatile relative to similar companies. It also fades over a longer duration of time because of its slow growth in assets. Building further on the information gathered from Holt Insights, I deduced that the CFROI experienced declines due to major asset growth changes and acquisitions earning returns which are above the hurdle rate but are still lower than the historical rates of return the company was earning overall. This dilutes the CFROI level, causing it to decrease. There's a lot of variation in asset growth, with a general positive trend of increased reinvestment back into the company peaking in 2010. This is caused by the decreasing and limited investment opportunities available to larger mature firms, leading to a lower asset growth rate. Overall, the market has reacted positively to the increases in the percentage of asset growth and negatively to the decreases in percentage of asset growth. Sales growth is varied but follows a distinct positive trend peaking in 2010. The peaks in sales growth with respect to other years have fueled increases in asset growth, for example in 1994 and 2007 when the company reinvested in its operations. Margins have been very steady overall, though small decreases have been observed from 2009 to 2013. Asset turns show a clear downward sloping best fit. These correspond with generally low sales growth levels, and these decreases in asset turns have been reflected in the decreased CFROI over the years. The market has had a positive outlook on Coca-Cola's prospects and evaluated the stock price at around $42, much higher than the warranted price of around $26. Stock prices are mostly closing downside, meaning that it's consistently overvalued. Given this, investors should sell the stock knowing its prospects under current underperformance in operations.